Well, our next guest says Western economies will see slower growth in 2011 as governments fail to address the key concern, too much debt. Nick Beecroft, senior markets consultant at Saxo Bank, joins us with more on his 2011 outlook. Nick, thank you so much for joining us here in the studio. Is there anything that surprised you, took you back in saying, well, actually, I thought it would go this way, but my findings and my outlook says otherwise?
Well, I think we're quite sanguine about 2011 in the sense that we don't see a double dip. We see, as you say, slower but steady growth. It's certainly in the West, maybe 2.7% in the States, 1.4% in Europe, but of the order of 5, 6, 7, 8% in some of the emerging market economies. What our concerns really relate to the medium term, and this is where we differ from most analysts who are quite optimistic about 2011. The medium term, I think we've just kicked the can down the road. The debt problem is still there, and we're just putting sticking plasters over it.
What does it mean exactly? That we're going to have a weak recovery, but also that actually these austerity measures aren't strong enough, or are they the ones that are too strong and therefore stifling the economy?
Well, I think the problem is that we converted the private debt problem, which caused the crisis, into the public debt, and that isn't a panacea. You know, unless you get the economies into a proper structural state for long-term growth, then you've just postponed the problem. We have insolvent countries, we have massive debt issuance, massive sovereign debt, which the markets will refuse to digest. At some stage, it may be in 3 years' time because of various funds and sticking plasters, but it's postponed that problem.
What is going to be the crunch time? A lot of economists have been telling us actually the problem is when interest rates start going up, and that may be sooner than we were hoping for because of inflation. That's really when it's going to hit hard.
Well, we could certainly have near-term crises in the short term due to the cost of bond issuance for peripheral countries, for instance. If that's persistently over 7% in the 10-year period, then there is the risk that they're all democracies, and the governments have to seek re-election at some stage and appeal to an electorate. At what stage does it become too unpalatable to propose these austerity measures rather than cut and run? Actually, we think the central scenario is that that won't happen for 2 or 3 years. The European Union will muddle through, probably through a de facto creation of fiscal union. But then, once again, the crunch comes after probably 2013, 2014. And
we have, of course, all of this cheap money mainly coming from the US, but going into emerging economies. How concerned are you about China's bubble bursting?
Well, we think that is it's a binary situation. It may well, China could go either way in terms of this tightrope that they're walking. In many senses, they're trying to control incipient inflation on the one hand, but on the other hand, not to derail the economy too much, so that employment is still created for the rural workers coming to the city. And on the other hand, inflation is a real problem. Food price inflation, especially, was a root cause behind the Tiananmen Square uprising. So they are really walking that tightrope. We think probably successfully, in the sense that growth will still be 8% minimum this year.
Some will be jealous of that.
Some will be very jealous of that, but probably a little slower than last year.
Nick, thank you so much. Nick Beecroft there.